The upper strata of society are fiercely competitive, and many will do all they can to succeed. Several manipulative masterminds sit on a throne in the world of finance. The perpetrators of these white-collar crimes take the benefits of institutions and all groups of citizens, ultimately bringing destruction and chaos. Stay tuned to know about one of the biggest scams in history. Hello everyone, and welcome back to another episode of our channel. In today's video, we will be talking about Bernie Madoff and how he stole $65 billion. Financial Bernie Madoff's crimes, who died on Wednesday, have faded out of the headlines, but Ponzi was one of the most significant financial stories of the last decade, the largest in history. Madoff, 82, was once considered a wizard on Wall Street. Investments made by his clients, including celebrities, companies, and charities, were well regarded by Nasdaq's former chairman of the stock market. In 2009, Madoff was sentenced to 150 years imprisonment because he had run a pyramid scheme so far that only a handful of his victims recovered their total losses today. By 2020, the U.S. Justice Department returned about $3 billion to individuals Madoff had known. Madoff persuaded thousands of investors to distribute their investments as a reputable financier, promoting falsely consistent benefits in return. He was arrested in December 2008 on charges of fraud, laundering of money, perjury, and theft. But how did he manage to do the scam? Before getting into the mechanism, let's understand what a Ponzi scheme is. By promising usually high returns, 50% return on investments, the Ponzi schemes attract investors. The name came from Charles Ponzi, a con artist who, in 1920, for his scam, promised and finally was sentenced to 14 years in prison. A central operator who uses the money of new incoming investors to pay the guaranteed returns to older ones runs Ponzi schemes. This renders the operation sustainable and legal, although there is no real benefit. In the meantime, the individual behind the scheme expands the operation with extra capital. Ponzi schemes allow them to remain in the game and raise more money to prevent too many investors from retrieving their profits. The investing strategies, which according to the schemers protect their companies, are ambiguous or secretive. Then they have to tell investors what they do regularly without ever returning real money. Usually, Ponzi plans are not very viable. Eventually, after the operator takes the money left behind and runs, it becomes more difficult for new investors to identify, i.e. cash flow disappears and too many existing investors start to retire and ask for returns. A Ponzi scheme is when an individual is taking money for a fraudulent business product from investors. Investors believe that the money they receive is legitimate income from the product and comes from new investors. The plan is like a pyramid structured. To make it simpler, let's say from two first-round investors, an individual takes $500. This $1,000 requires him to find another batch of investors who will pay at least $1,000 in combination to repay initial investors and make a profit possibly. In terms of people and resources spent, the chain reaction continues to develop. Fraud mechanisms. Under a U.S. Securities and Exchange Commission proceeding, Annette Bongiorno and Joanne Krupi, office staff, have generated fraudulent commercial reports based on returns requested by Madoff for any client. For instance, if Madoff determines a customer return, one of the back office employees will enter the previous false trade report and then enter into the false trade closing following the indictment, as much as is necessary to achieve the required benefit. Fiscal prosecutors claim that Bongiorno uses a computer program designed specifically to back up businesses and exploit accounts. Returns were, in some cases, supposedly decided before the account opening. De Pascali, a key lieutenant of Bernie Madoff and his team, watched the closing price regularly for the S&P 100 on the 17th floor of the Lipstick building. The S&P 100 index is an index of the stock market held by Standard & Poor's in the United States. Their best performing stocks were then picked up and used to establish fake stock packs as a basis for fake trade documents, alleged by Madoff, resulting from his supposed split strike conversion strategy where he took options contracts on the blue chip stocks purchased by him. Often, they did their trades in a high or low of stocks monthly, resulting in high returns for customers, which they touted. Often, they have slipped up and dated trades on weekends and federal vacations, though they have never been caught. Madoff has warned his investors over the years to remain silent about their connection to him. He was well aware of the limitations for illegal split-strike conversion that exist. He knows that if the amounts he manages are known, investors will ask if he can trade the extent he claims without reacting to his activities on the market, or if there are sufficient opportunities to protect his stock purchase. In 2001, Harry Markopolos, former U.S. executive director of the securities industry and an investigator for forensic and financial fraud, found that he had to buy more options than currently existed in the Chicago Board Options Exchange to be legal for Madoff's plan. In addition, Suzanne Murphy, at least a hedge fund manager, disclosed that she refused to invest with Madoff because she did not believe there was enough volume to support his trade. While Madoff finally grew into a multi-billion-dollar company, none of the major derivatives companies traded with him because they did not believe his numbers were genuine. None of the largest Wall Street companies invested with him, and most senior managers suspected his activities, and the statements were not legitimate in those companies. Others argued that the Documented Accounting or Audit Company, a three-person company with one successful accountant, could competently and legally serve the increasing volume of Madoff's accounts. During his March 2009 guilty plea, Madoff revealed the essence of his plan. Instead of investing it and generating steady returns as customers claimed, he deposited client money into a bank's account. When customers needed their money, he used the money to pay the requested funds in the Manhattan J.P. Morgan Chase bank account that was part of them or other customers. He said he started the fraud in the early 90s, while prosecutors claimed that it was already in progress in the 1980s. DePascali told investors that he knew sometime in the late 80s or early 90s that an investment consulting company had become a fraud. An investigator responsible for reconstructing the Madoff scheme claims that the crime had already taken place in 1964. Madoff said that the scam started almost immediately after his company opened its doors, shortly after his arrest. Bongiorno, who spent over 40 years with Madoff, longer than anyone other than Ruth, his wife, and his younger brother Peter, told the investigators that she was doing the same in 2008 when she first joined the company. Early in the investigation, the scale of the fraud was reported at $65 billion. The current net fraud valued at between $10 and $17 billion, former SEC Chairman Harvey Pitt. The results of various measurement methods vary on each estimate. One approach measures losses as the cumulative amount they were supposed to receive but never did receive. The lower figures are calculated by excluding from the scheme the total cash collected by excluding persons charged with collaborating with the scheme, persons who have contributed through feeder funds, and all persons who received more cash than they paid in. The journalist Aaron Arvedlund, who openly challenged Madoff's reporting of 2001's investment, estimated that the real fraud figure could never be determined but was probably between $12 billion and $20 billion. To get investments from the Jews, Madoff targets rich American Jewish companies using his community status. The Hadassah, the Women's Zionist Organization in America, and Elie Wiesel Fund, and Steven Spielberg's Wunderkinder Foundation are the Jewish charitable organizations deemed the victims of this affinity scam. Jewish federations and hospitals lost millions, and some organizations were forced to close. Since the Lapin Foundation invested its funds with Madoff, it has had to close temporarily. Madoff was a well-versed and committed member of the financial sector. That is why he succeeded in flying under the radar for so long, despite numerous SEC warnings regarding suspicions of a Ponzi scheme. In 1960, he founded his own company to construct the Nasdaq bond. He was a member and advisor to the Securities and Exchange Board of the National Association of Securities Dealers. The veteran of the industry could easily believe what he was doing. In the middle of the Great Recession, the system started to crumble. When investors flocked in 2008 to withdraw their capital, Madoff had no funds to meet the request stream. Finally, he told Mark and Andrew, his sons, of the scam. They contacted federal authorities, who eventually arrested Madoff. Madoff has been a prominent philanthropist serving on nonprofit boards, many of whom have entrusted their company's endowments. The breakup and freezing of his personal properties and his company have impacted internationally, included the Chase Family Foundation, the Robert I. Lapin Charitable Foundation, the Pi Cower Foundation, and the Jet Foundation, forcing them to close. After his son Andrew was diagnosed with the disease, Madoff gave over $60 million to lymphoma research. Since 1991, he and his wife gave more than $230,000 for political reasons, and the majority went to the Democrats. With this, we have come to the end of the video. Thank you for watching the video to the end. Don't forget to smash the like button and subscribe to the channel. If you don't want to miss any further information, then make sure you hit the bell icon. See you in the next video. Till then, bye.